Benjamin says, for IULs, is it better to pay monthly or yearly? It depends on what is best for your budget. You're going to, with IULs, it's a little bit different. It's a little bit different than whole life policies. With whole life policies, it's cheaper, it's less expensive if you pay yearly. Because whole life policies, when you do a monthly premium, they assume that you paid it all at the beginning of the year or all at the beginning of your policy anniversary, and they're going to credit you the dividend rate for the whole year based on that. So when they stretch your payment out over the month or over month to month for the whole year, they increase it slightly to account for that dividend that you didn't actually have the money in, but they're crediting for you. So they're going to add a little bit to that. And then also it's just like any other company, like your insurance company. If you break up your payments over the year, they tack on a little bit extra just for doing that. So with whole life policies, you're slightly better off, depends on how big your premium is and what they're breaking up on that. The way I design it with Guardian, it's just based on the base premium, so it's a very small amount, doesn't make a very big difference overall in the life of the policy. And year to year, I mean, you're talking a pretty small amount of money. If you have a very large premium, though, it could make a bigger difference. Or if your agent set it up to where, with Guardian at least, it's not unscheduled premiums, it's all scheduled paid up additions, they will break up those scheduled paid up additions and give you that credit right at the beginning. So if you can't put all of the money in at the beginning, spread it, and it has to be spread out. You want to get it spread out with just the base. And then when you do end up putting the money into it, you'll earn the dividend from that point on. Now with IULs, it's a little bit different. You have the underlying cost of insurance that is going to be in there, and that is what's going to be broken up as far as each month. IULs, it looks to me, with how they do the policy charges, they always assume monthly payments are going to be there because they charge you a monthly fee just to keep the policy going, and it's something like $12 a month. It's not very much. It's like $70 a year. It depends on the company, but I think they already have that built into it. And you have the flexibility with the IUL of putting in as much or as little as you want each year. As long as your cash value is enough to cover the cost of the insurance for the year, they don't really care when you put it in. And I attribute that to them basically charging you for monthly deposits, regardless of whether you actually do it monthly or not. So the biggest difference as far as putting it in monthly or yearly on the IUL is going to be the index segments that you end up with. The sooner you get the money in, the sooner you're in the index, the sooner you can get growth on that policy. So case in point, my policies, I had three different times over the year that I put in premiums in the first year. So I ended up with three different segments. The stock market performed differently on one out of those three segments. So the other two were the same. I ended up hitting the max on the two, and then right in the middle of the pandemic was when my third one came up and it dropped. I thought I was not going to earn anything, but the market came back just a little bit right before my segmenting period. I ended up getting 2%. So I got 11% on the first two, and then I got 2% on my last segment. So that can make a difference. Timing can make a difference when it comes to what you end up being credited. Now that doesn't mean it's necessarily good or bad to have it all in one or broken up into multiple ones. A lot of these companies offer the ability to have, it's very similar to dollar cost averaging, but they'll basically split it up into 12 segments for you so you get one each month. And that's basically spreading out your risk of any one point hitting in a downtime and the rest of them being up. So I haven't done the numbers on this yet, and I'm planning to crunch the numbers to see which one is better and put a video up on that, but I haven't done it yet. But the idea is if you put all of it in for one segment, that segment could be up or down when it rolls around the next year. If you split it up, now you have 12 segments that each one could be up or down, so that you have a more a higher likelihood of getting some growth every single year rather than just a growth or no growth in any particular year. So that's the idea. Up to you how you end up ultimately wanting to fund it and try it out. And when I do get that video made, you can be sure I'm going to share it with you all. This was a question asked and answered during one of our Wealth Care Wednesdays live streams. If you have any questions, leave them in the comments section below, or join us on one of our Wealth Care Wednesday live streams where you can ask the question and we'll answer it on the air live. I hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here, and we'll see you next time. Now go maximize your cash flow.